Welcome to The Explainer. Okay, today we are fundamentally shifting how you look at accounting. Seriously, we're going to stop treating financial statements as these, boring, isolated list of numbers and start looking at them for what they really are. It's a living, breathing, fully interconnected machine. We'll be drawing directly from a really comprehensive finance tutorial by expert Alyssa Smith to build a complete three-statement financial model entirely from scratch. So let's dive right into this. Here's the quick blueprint of the machine we're about to build together. First, we're measuring rate of return. Second, the three-statement model. Third, building the income statement. Fourth, forecasting the balance sheet. Fifth, tracking cash flow. And finally, number 6, running that final balance check.
All right, part 1, measuring rate of return. Before we can even start modeling the future, we actually have to set up our output dials to quantify historical gains and losses.
So to build our rate of return calculator, we need historic data. And as Alyssa points out in the source, pulling this is honestly incredibly straightforward. You just hop onto Yahoo Finance, search a safe stock, let's say Disney, grab 2 years of historical data, set the frequency to monthly, and download the CSV file. Easy, right? But here's the kicker. Once it's in Excel, we actually delete almost everything. Yeah, we only keep the date and the adjusted close columns. Why adjusted close, you ask? Because it actively accounts for things like stock splits and dividends, giving us the absolutely most accurate picture of value. The math behind comparing massive asset classes is actually surprisingly simple. It all comes down to the holding period return, or HPR. By taking the ending value, subtracting the beginning value, and then dividing that whole thing by the beginning value, we get a standardized percentage. And that percentage is absolutely crucial for making informed choices on exactly where to allocate capital. Moving on to part 2, the three-statement model. Now that we understand our metrics, we are totally ready to build the core engine where the real business forecasting happens. Now, every statement in our machine has a highly specific role. Think of the income statement as the pulse. It measures the live operating activities, basically your revenue versus expenses over time. Then you have the balance sheet. This is the skeleton. It's a rigid snapshot of the company's exact financial position at one single specific moment in time. And finally, the cash flow statement is the circulatory system, tracking the actual physical cash entering and leaving the business. Now, they all function independently, sure, but they must act together if you want to diagnose a company's true financial health. Which brings us to part 3, building the income statement. For this explainer, we're going to use our source's example of a mail-order cookie company, and we'll track everything from gross revenue straight down to operating expenses. Okay, as we start inputting formulas for things like cost of goods sold and HR expenses across 4 separate forecasted years, we really need a time-saving superpower. In Excel, that is the F4 key. Hitting F4 creates an absolute cell reference. Basically, it magically inserts a $sign into your formula. This locks your assumption row completely in place, meaning you can literally just drag your formula across all 4 forecast years instantly without breaking the math at all. Seriously, if you want to save a tremendous amount of time, commit this shortcut to memory right now. So, as we build our way down the income statement, we hit a massive financial acronym, EBITDA. That stands for Earnings Before Interest, Taxes, Depreciation, and Amortization. This is a super critical metric for private equity because, well, it acts as a proxy for cash flow. To get it, we calculate our operating income first. But listen closely. Here is a vital secret to building this machine. We intentionally leave depreciation and interest entirely blank for right now. Why? Well, because those numbers represent physical assets and debt, and we literally haven't built the balance sheet yet. And that leads perfectly into part 4, forecasting the balance sheet. Now that our company has a pulse, let's step over to our skeleton, that snapshot of the company's financial position at one given moment. I need you to commit this next equation to memory because it is the absolute golden rule of accounting. Ready? Total assets absolutely must equal total liabilities plus shareholders' equity. The two sides of this equation must perfectly balance to 0. No exceptions. If they do not equal each other, the machine is broken and your forecast is completely invalid. Let's take a look at the actual bones of this skeleton. Under assets, we've got cash and accounts receivable, money owed to us. Under liabilities, we have accounts payable, money we owe to others, and long-term debt. But look really closely at deferred revenue. This is fascinating. Deferred revenue covers services you've sold, maybe even taken a down payment for, but you haven't actually performed the work yet. And because the work isn't done, it legally cannot sit on the income statement yet. So it just waits right here on the balance sheet. So the crucial point here is the interconnectedness. This is exactly where we start wiring the statements together. To calculate retained earnings in the equity section, you must take last year's retained earnings and add this year's net income. And where do we get this year's net income? Boom, we link it directly from the income statement we just built. I can't stress this enough. If you don't build this link, your balance sheet will simply never balance. All right, part 5, tracking the cash flow. We've got a pulse and a skeleton. Now we move to the circulatory system, the cash flow statement. Interestingly, this statement actually begins by pulling the net income straight from the income statement, and then it methodically subtracts out any non-cash expenses. Now, cash is tracked across 3 distinct buckets. First, operating activities. This handles the day-to-day stuff, net income, depreciation, and changes in what people owe us or we owe them. Second, investing activities. These track capital expenditures, like, say, buying shiny new ovens for our cookie company. And third, financing activities. This tracks the really big money moves, debt repayment or taking on net new borrowings. When you're calculating these changes in cash flow in Excel, you really have to notice this crucial difference. For accounts receivable, which is money owed to us, the formula is last year minus this year. But for accounts payable, money we owe others, it is the exact inverse, this year minus last year. Cash owed to us acts inversely to cash we owe others. Think about it. If someone owes us money, that cash hasn't hit our bank account yet. But if we owe someone else, we are currently still holding on to that cash. Which brings us to part 6, the final balance check. We've built all the components. Now we pull our net cash flow from our newly built cash flow statement and link it directly back to the top of the balance sheet to calculate our total cash. I absolutely love this quote from our source instructor, Alyssa Smith, because it just perfectly captures the sheer tension of financial modeling. Listen, this is what gives everybody a heart attack if it doesn't work, right? We've built all 3 statements, we've linked net income, we've dragged our cash flow back to our assets. Now we run the balance check, total assets minus liabilities and equity. The result must be 0. If it isn't, yeah, cue the heart attack. But let's be totally honest here. Financial modeling is notoriously intimidating, and these ecosystems break easily. If your balance check isn't 0, take a breath. Don't panic. There is a very specific diagnostic path you can take to hunt down exactly which wire is broken in your machine. So the crucial point is systematically checking your connections. Just run through this checklist. Did you successfully link net income from the P&L directly to your retained earnings? Did you link the final cash flow total back to your balance sheet cash line? And here is the biggest culprit of all. Did you forget to include a specific balance sheet account, like accounts payable, inside your cash flow statement? Because if you missed even one, your machine is never going to balance. So we've successfully built the entire ecosystem, the pulse, the skeleton, and the circulatory system. But I want to leave you with this final provocative thought. Because this machine is so tightly interconnected, being off by a single dollar means you have to trace the logic backward through the entire thing. So if your balance sheet is off by $1, where would your diagnostic journey begin? Understanding exactly how these statements feed into one another is the true superpower of financial forecasting. Thanks so much for joining me on this explainer, and hey, enjoy practicing your new modeling skills.